In this video I'm going to show you how Navision uses the expected cost posting with both purchase and sale. But before you watch this video, I strongly recommend that you watch the basic scenario video, which will show you the basic postings that Navision does when you buy and sell items. But first I'm going to go over all the postings on a number of slides. The two for purchase will be a receiving slide and then an invoicing slide. And then on the sales side, I'm going to use a shipping slide and a invoice slide. And this should give you a complete understanding of the accounting and bookkeeping side and the reasons why Navision posts as it does. When you have a full understanding of how Navision posts in these different scenarios, I'm going to first show you how to set up Navision in order to perform this demonstration. And then I'm going to first make a purchase order, which I will receive and then invoice. And then afterwards I'm going to make a sales order, which I will ship and then invoice. So in order to use this expected cost scenario, it's important that expected cost is switched on. And this is done in the inventory setup menu. Also, it's very important that we receive an invoice in two steps. Let's say you've put an order at one of your suppliers. He delivers this item, but it doesn't have an invoice. So you have a problem because you don't really know what the value should be to put it on inventory. So you have to take your best guess at the point in time of receiving. Then maybe 2 weeks later you receive the actual invoice from your supplier. And it's not until this point where you actually know what you're going to pay him, and also what the value of the item is going to be when you put it on inventory. So if you are to receive an invoice in one go, there's no need for the expected cost posting. So Navision will not post in this way that I'm going to describe. The same goes for the sales side. When you need to use the expected cost, or the expected cost will only kick in when you ship an invoice in two steps. Of course, expected cost has to be switched on, but you need to ship an invoice in two steps, because if you ship an invoice in one go, there's no reason for the expected cost posting. So you also need to purchase before you sell. I have another video where in the case where you actually sell your items before you know the price that you are paying, or put in another way, you're selling before you buy. But this is described in another video. So in this case we are going to receive an item. When we receive it, we don't know what the value is going to be, what the cost is going to be, so we can't really put it on inventory at any final value. So when we receive, we take our best bet and put it on inventory at an expected cost of 8. So then later we are going to receive the invoice from our supplier, and it will say $10 for this particular item, and we're going to put this item on inventory at $10. Then eventually we're going to ship an invoice, that is sell the item, and we're going to be doing both the shipping and the invoicing at $20. It actually doesn't matter if you change the price from the shipping step until the invoicing step, because the $20 relates to the sale, and this expected cost posting is only relevant for the cost. So let's go through the first step here, which is receiving from the purchase order. So you need to create a purchase order and you need to click the post button, but only receive. So when you just receive, the total number of GL entries are 2, as you can see below here. So these two postings should be understood in the following way. When you receive something, your inventory is actually worth more, because now you've put another item out on your stock, out on your inventory. So if, let's say, you do an inventory count, your inventory is worth more because there's one more unit on your inventory. So you might argue that your inventory should have been updated, which it is not. And the reason it's not is because Navision thinks, well, I'm not going to update the final inventory account because I don't really know what the value is going to be yet. So I'm going to put it on this inventory interim inventory interim account at my best guess value. That's for the debit, and the counter posting, the credit posting, goes in your liabilities area here. So because when you put something on inventory, it doesn't come free, so one way or the other you're going to have to pay somebody eventually for that inventory increase. So for now it's just being posted in your liabilities area at a value of 8. So that made it up for the receiving part, which I have kept on this slide. So in this scenario, we actually receive the invoice from our vendor, and it turns out that the cost of the item was $10 rather than the expected 8 that we expected previously when we received the item. So what happens when we actually go and invoice the purchase order? Well, first of all, it creates 7 GL entries here. And I've tried to break those 7 GL entries up into 3 kinds of postings. The first kind is rolling back the expected cost. There's no need anymore to have anything posted to your interim account. So in order to get rid of what you originally posted when you received it, there's a counter posting here which sets this inventory to 0. And this is a credit, and the counter debit for this one goes down here, and this also sets the balance to 0. So this one and this one is to roll back the expected cost. So the next one is the purchase cost, and when you buy something, the way that Navision thinks is that, well, we're going to have a cost. So it's going to cost us $10 to buy this item. Keep in mind now that the reason it's 10 is because we received the invoice and we now know that the actual value is 10. So we have a cost of 10, and because we also have to pay our creditor some VAT, we have to pay our creditor or our supplier or vendor, we have to pay him $12. So the pink postings are the cost that we have had, or the purchase. However, Navision does realize that this is not actually a cost, because it does have a value to our company, because it's an item that is not consumed. So Navision is going to pull that cost out of the cost section again and put it into the inventory. So the final outcome of the receiving and invoicing process on the purchase side can be seen now here in the balance. We have 10 on inventory. We don't have anything on our interim account. We owe our creditor $12, and we can reclaim or get $2 back from the tax authorities. And also, we've had no cost at all, because these two cancel each other out. So now it's time to look at this expected costs scenario, but on the sales side. So we're going to start out with the shipping process or procedure, which is done once again from a sales order where you click post, but you only ship it. So when you ship this item, Navision creates two GL entries, and they're both related to cost. So the first one, if you think about it, when you ship an item, your inventory is decreased by the value of that item. So, but Navision doesn't post that to the actual inventory account. It posts this reduction to an interim inventory account. So the reduction is posted here. How can you think about the counter posting or the debit for this credit? Well, when Navision calls this account cost of goods sold interim, which sounds a lot like it should belong in the cost section. So I personally think that a better description of this account would be goods shipped, not invoiced. So you could look at this account as another kind of inventory account, that is all the inventory which is currently not in your warehouse but is either on their way to your customer or has actually arrived at your customer's warehouse. Also, you might ask, so why don't we just post these 10 to our cost section? Because isn't it cost of goods sold? Yeah, it is cost of goods sold, but we haven't invoiced now. That means we haven't hit our revenue account, we haven't hit our sales account with anything yet. So if we were to post this to our cost section, our cost would be not matched by the sale. So if we had a look at our profitability, we would have too much cost down here as compared to the sale. So it wouldn't be right to post these $10 to the cost section. Okay, so next we'll look at the invoicing process still of the sales aspect. So when we invoice, Navision will create 7 GL entries. And as with the other examples, I've tried to break those 7 entries into 3 different kinds of entries. So if we look at the first one, the rollback of cost of goods sold interim. So basically these 2 entries down here, they neutralize or cancel out what we did when we shipped the items. Because now we know the real cost, so we don't have to book it like this. So we need to roll that back. The second part of let's take this one first. The second part, which is the green entries, are the actual cost of goods sold. So you could say that the actual cost of goods sold replaces what we expected in the previous section. So the cost of goods sold will reduce our inventory here, and it will book or post some cost of goods sold here. And finally we have our sales transactions, which are marked with the pink color, and we have a sale of 20. It's minus because it's credit, so this is a good sale. We have a debtors or accounts receivable for 24, and the reason it's 24 is because we expect also our customer to pay some VAT, which we'll be able to pass on eventually to the tax authorities. So in conclusion, the net effect of this entire case, the receiving, the purchase receiving, the purchase invoicing, the sales shipping, and the sales invoicing, can be seen in this balance here. So we've had, or right now we expect to receive $24 from our customer. Our creditors need to be paid $12, and we need to pay the tax authorities a total of $2. On top of that, we've made a sale of $20, and summarizing this, the cost section tells us that we've had a cost of 10 in total. and it's booked on this account. Okay, so now I'll show you how to set up Navision in order to prepare for this expected cost scenario. So the first thing we'll just have a look at is the chart of accounts, and if we go here, you'll see at the bottom, all the way down here, I've prepared a mini chart of accounts which is identical to the one used in the slides. Then we have to have a look at the inventory setup and make sure that it's switched on to expected cost. So we go here, and expected cost is switched on. You should also switch on automatic cost posting and automatic cost adjustment. You should set that to always, otherwise you'll have to run a few batch jobs to make it actually post to the general ledger. So this looks as it should. Then we have to look at the general posting setup. So we'll have a look at that. And this is not a tutorial or instructional video on how to set up posting groups, but I'll just show you quickly how it's set up so that you can replicate it. I'm using a combination of two, a product posting group and a business posting group that I've created. And if I just filter to this one, so we will see nothing else. You look at the sales account needs to post to the sales account in the mini chart of accounts, and you have your purchase account here. You have your cost of goods sold account here, and you have your direct cost applied here, and the last two to be set up here in this. They're all pointing to the mini chart of accounts, and if you want any more info on this, you should go back to the slides. So then we have to check the inventory posting setup. And I've also created an inventory posting group here, and I'll just filter to that value so we only see that. You need to set up the inventory account and the inventory account interim. Then we have our vendor payables account. Or our vendor posting groups we need to set up. And I've created a vendor posting group just called vendor. And the only thing you need to set up here is the payables account. And then we have the custom posting groups. And I've created one called customer, which points to the receivables account. And then finally we've got some VAT setup, VAT posting setup here. And I am using a combination that I've set up myself, which is national and VAT 20, and it posts for the sales VAT, it posts to, well, our sales VAT account, and for the purchase VAT it posts to the purchase VAT account. Okay, so let's start with the first part of the 4 steps, which is the receiving of the goods. So we need to do it from a purchase order. Otherwise we can't split up the receiving and invoicing in 2 steps. So we're going to create a new purchase order. And I'm using a vendor simply called vendor. It's one I've created. And in our items, or on our purchase order lines, we need to do item, and then I'm using one called chair, also an item that I have created. So we've got one of those, and keep in mind we wanted to receive them. We're at the point of receiving, we're expecting our supplier to invoice us at 8, but we don't know yet. We just received the order, the items. So our direct unit cost is going to be 8 for now, and then we can post this one. And remember only to do receive. Okay. Okay, so now we've received this order, or this item, quantity received. That means that there's also been created a posted purchase receipt. So we'll just have a look at this, and we'll navigate on that to get to our GL entries. And these two GL entries are exactly the same that I went over on the slides. So looks good so far. Okay, so now we can go back to the purchase order here, and we want to now invoice the order. But because we've now received the physical invoice, we can tell that our vendor or supplier has actually invoiced us $10. So we'll just change this. Actually, we'll need to reopen the order before we do this, otherwise we'll get an error. So I'm just going to reopen it first. It's open now, and we can change it to 10. So I'm just gonna go and invoice it, but we're probably gonna get an error. Receive an invoice. It doesn't matter whether you choose invoice or receive an invoice, because everything has been received. So I'm just gonna go with receive an invoice. Yeah, we need to put in a vendor invoice number here. Just anything. So post this again. So now the purchase order has been fully received and invoiced, so it has been deleted. So we can find the purchase invoice under posted purchase invoices, and it's going to be the last one. So if we have a look at this one and we navigate, we should see our 7 inches, just as expected on from the slide. So we have some entries that back it out of the interim inventory. We have our cost, our purchase here, and so on. So this is the actual cost, the $10 that we know when we invoice it, and these two up here were in order to back it out of the interim receiving accounts, just as on the slides. So now we can move on to the sales scenario, and I'm just gonna change the work date, push it forward just 1 day, because we are running with FIFO, and sometimes it confuses things a bit more than necessary if you do everything on 1 day. So sales orders. Once again, we have to do this from a sales order because we have to split the shipping and invoicing part. So we need a new sales order, and I'm going to use a customer that I set up, just called customer. We're going to click that yes to this credit limit check, and we're going to sell the chair that we just bought. One of those, and we're going to put in 20 in the unit price here, and then we're going to post it, but only ship it to begin with. So this was on one day. We've shipped it now, and we can go and see the shipments connected to this order. And if we navigate on this particular shipment, we'll see that it has 2 GL entries here, posted exactly to the accounts that we expected it to. And now we can go back to our sales order and perform the last operation, namely the invoicing of the sales order. So we actually don't have to change anything. We can just go ahead and post it. Click ship an invoice or just invoice, enter. And the sales order is now gone because it's been fully shipped and invoiced. So we'll have to find it by looking for posted sales invoices and go all the way to the bottom here. So this is our invoice, and if we navigate, we've got our chair here. If we navigate, we'll see we've got 7 GL entries just as we expected, and we've got the number, the figures doesn't change on these costs. It's only the accounts that that changed. So it backs it out of the expected cost accounts and puts it into the cost of goods sold here and pulls it out of the inventory. And then you have the 3 sales entries here.